Hello, YouTube. Today we're going to be talking about what the FOMC or the Federal Reserve said and why it moved the market. Here we're going to be looking at the 10-year Treasury note. We can note that it is having a substantial move higher. We are now up by roughly 4.2%, getting awfully close to that 3% area again. So after a roughly 20% decline, we are now up by roughly 6% off the bottom. So what exactly did Jerome Powell and the Federal Reserve have to say to move the markets? Well, it's a little simple. Again, this is going to be a look back to their June meeting where we are now able to see the minutes for what they actually said. What it tells us is that the Fed embraced a big rate hike amid fears of eroding inflation outlook. They are debating between 50 and 75 for the next meeting. And there were a lot of headlines. These are the most important ones, though. They are pretty much moving in unison, and it's either going to be 55 or 70 at the next meeting. However, this is backwards looking data. So we're going to look at something else in a moment. Actually, let's just pull it up right now. So this is a dot plot. The dot plot signifies where the individual members of the FOMC or the Federal Open Market Committee, better known as the Fed, want to have interest rates. We can note that each dot represents a voting member, and then we have a line. The line represents the median. So here we can note that the green line represents the median dots. We can also note that it went up into 2023, and now it is going down. This is assuming that the Fed has inflation under control, and we're actually going to come back down to about a 2% rate on inflation. So that's what's really important here. Another way to think about it is that bond yields climb on hawkish FOMC meeting minutes. So yes, today we are closing higher. But previously, when we've closed higher on FOMC meetings, meaning the day that Jerome Powell speaks, we've actually had a trap. So when we look at the charts in a moment, this is going to be very important for us. So again, closing this out, we can also note that, again, this could be the end. This could be the peak hawkishness that a lot of people have been talking about, and part of the reason why the market saw some relief today. The S&P is closing up here by about 0.35, but we've got 3 back-to-back green days in a row. That is not something we've seen in quite some time. Actually, going back to last week. My apologies. 2 weeks ago, sorry. So can we understand what this means? Well, it means that the Fed does not think they're going to be able to keep hiking, or that their policies are already having an effect. And here I'm going to show you 2 more quick things. So we already kind of had a warning about this. This is back to June 7th. This is from Ray Dalio from Bridgewater, who tells us that central banks to cut rates in 2024. That's pretty much what we see here, right? Start lowering interest rates and then lower interest rates even more into the long term, meaning 2025 and beyond. So who is Ray Dalio and why do we care? This guy runs the largest hedge fund in the world, also returned the most money to the people who run his fund. And this also came out today. So again, that article is from roughly a month ago. This one is from today. Bridgewater's flagship hedge fund gained 32% for the first year. So this has been the worst drop since 1970, but Ray Dalio and Bridgewater are returning huge gains. 32% for not the largest assets under management or AUM, but the hedge fund that has returned the total absolute dollars back to investors. So when we think about $140 billion under management, so 140 times a return of roughly 0.32, it means that he's returned about $44.8 billion in about 6 months. That is incredible when we think about where the market's gone. So part of the reason why I really pay attention to Ray Dalio is because this man's smart and he likes to make money. So last thing we'll talk about here is just that if we look at the 10-year note, and again, the 10-year note is going to be basically the risk-free return, what you can get relatively risk-free, USO 10. Let me just make sure I have the right chart up here. Let's go to US 10Y. There we go. So this is the 10-year note, and we can note that it's been going up pretty steadily ever since 2020, from roughly 0.3 up to about 3. That is a 10x return, or 1,000%. We're currently in a range, but what's important here is, again, where we peaked out at roughly 3.5%. So roughly 3.5 is where we had the peak of the hawkishness going into 2023. Now we're expecting to get down to roughly 3 and then lower into the end of the year. Longer term. So the reason why that 3% is also very important is because when we look here to the Fed funds effective rate, or historically what the Fed has charged going back to 1955, what do we have here? Well, as technicians, this pattern should be very obvious to us. It's a head and shoulders. What happens when the head and shoulder starts? We get the knees and toes. And when we look here at the line, we're approaching an area where something historically breaks, meaning every time we've previously tested this downtrend, I'm talking about here, 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 and here. This goes back to 1982, 1990, 2000, and 2008. We've always had a reversal. So that is what's so important here, because we're almost there, right? If they raise by 75 in July, we're pretty much going to be at the point where something breaks in the system. Keeping in mind that they've not actually began QT or quantitative tightening, and it is the summer where we have low liquidity. So putting this all together, what it tells us is that right now, the market is leading the Fed, meaning that we peaked at 3.5 before the Fed confirmed it, and now we're actually coming back down before the Fed confirmed it. So what does this mean? The market's leading the Fed. And the reason why we have to pay really close attention to the 10-year note is because it is inversely correlated to what tech stocks do. So the higher the 10-year note goes, the more it's going to impact tech stocks. Again, thinking about growth stocks that are unprofitable. As your cost of borrowing rises, it means that it's going to be more difficult to run an unprofitable company, which is why we see a lot of names like under the Cathie Wood banner, which will be getting stomped. And part of the reason why her fund is down today. I would also note that the 2 and 10-year notes are inverted again, and it is holding. So what does this usually mean? It usually means recession is on the horizon. When you get paid more to lend to the government for 2 years than for 10, what it tells you is that interest rates are forecasted to be higher for the next 2 years than they are for the next 10. It's that simple. So putting it all together to tell us a story in terms of where the market's going to go, I think that there are traps being set right now. So let's close this all out and let's have a look at our next board, because I'm trying to keep myself a little bit more organized as I do these videos. So I want to look at a few more things here just to make sure that we understand the landscape. So looking at the heat map, it's pretty mixed today. Not a whole lot going on. If we group it by sector, now we note that, okay, technology is doing okay, finance is down, consumer durables are down, energy's down, consumer services are also down, but it's pretty mixed. So the better picture for us is going to be to zoom out to year to date and see whether or not any of these stocks have actually exited bear market territory. There's the king, Apple. Only negative 19.75 since the beginning of the year. So what does that mean? Apple is exiting bear market territory as of right now, as of the close today on July 6th. Is it going to hold? I don't know. But what I really want to see is Microsoft, Google, and a few other names get out of that bear market territory. Otherwise, this is likely just going to be another dead cat bounce and another trap. So I'm looking specifically at Microsoft and Google, which between the three of those, they represent the largest weighting to the SP 500. Another thing to look at here is going to be the S&P. So again, we made it up above 385 today, almost to 386. And the question that we had was whether or not we were actually going to get some conviction to close above 380.5. Looking back to the screenshot here, what we can notice just that ETF traders sell during the latest equity bounce and departure from earlier this year. So what was really interesting is just that we saw a huge rip today. We saw a rip after we had the minutes come out, and then we had continuation after. So putting it all together, we'll have a look at the options chain as well. But here is our daily Smp chart, which we've been looking at. Again, still have some gaps in the chart here. This one here has now been filled, so we can delete it. We still have a lower gap here, but what we can notice just that there's lower tails. Those lower tails signify dip buying. So 1, 2, 3, 4 days of dip buying. And now we have a doji or indecision. Remembering that today was also OPEX because it's Wednesday. So we closed up on a Wednesday with the dollar up by 0.5% and the 10-year note also going higher. Whoa, looks like it's Tina back to America. You got it. What we looked at yesterday as well was the put-call ratio, and we can note here that it's a lot more even than it was yesterday, 60-40 split, which means that we have a 1.5 put-call ratio. It's still skewed bearish, which means it might be a trap. So now when we keep in mind that outflow, that could have been what's happening into the close. I have a strong suspicion it was largely options related though. And I'll look at that in a moment after we look at the technical chart. So again, understanding that 380.5 is a critical area, because if people were willing to sell up to 380.5, why would they not be taking advantage of that above 380.5? That's the most important question. And what's our low of the day today? 379.6, which means, if people were bearish, they had one more chance to potentially try to sell it down there. So there we go. All right, moving forward. That 380.5 is going to be very important as we come back and have a look at the charts in a moment. The last thing to keep in mind here is just that there's not really very many more economic data points coming through until Friday when we got payroll Friday. So we have the Fed speakers here with Williams today. Didn't really see anything from him. Also coming out on Friday. We got Waller and Bullard, who are hawks. So the Fed meeting minutes tell us what happened almost a month ago. The Fed dot plot is revised as of today. So old data is good, but new data is better. So I'll be paying particular attention to what Waller and Bullard have to say tomorrow when they speak together at 1 p.m. All right, having a look at a couple charts here now. So we understand what happened. We understand that we got a green line, we got a red line, we have a doji. So what does this mean? It means that we have an indecision after 3 back-to-back up days. And these are big up days. So prices covered all the way up here to 385.87, which looks pretty good. And when I look across the different asset classes, I see that QQQ, SPY up, VIX down, Treasuries up, oil down, gold down, crypto up. BTC actually back above 20. So it's starting to look like there is some risk appetite, but it's not everywhere. And we have to start seeing some stocks really start to lead. Apple is the king. It got downgraded from Goldman Sachs today, but it shook it off and closed up. The put-call ratios also show us that we're roughly back to a 1-for-1 for the broader market, which is going to be the CPC. And then the PCSP is going to be the S&P 500 put-call ratio. So it just means that there's 1.14 puts purchased for every call. In terms of ETFs, it's pretty mixed. Why? Well, we're expecting a recession here. So now if we look at the S&P to try to make sense of where we're going, again, we have to look at the chart. So what do we have here? There's a few competing patterns. First thing I note is just that if we look on an hourly time frame, this right here looks like an IHS to me, an inverse head and shoulders. So again, zooming in here to an hourly chart, what this looks like to me is an inverse head and shoulders. And where is our pivot? Our pivot is at 380.5. Oh, so we have a bullish pattern with a pivot at our key monthly low where people were previously willing to sell. That is correct. And if we're able to get a close above 384 and get back here into the next gap zone at about 389, that is going to get me pretty bullish. This 50 MA is racing down, and we have a much better chance of actually testing it now. All right, so a doji after an up move. All that means is indecision after already going higher. Now I'm going to look at the options chain, and I want to tell you that we have a couple of tools. We don't always talk about them, but we have our end of day target, and we have something called max pain, which is currently my brain. So going into today's trading, what I actually made about, I don't know, $2,000-3,000 into the close by just using these simple tools to try to understand where they want to burn. And when I look here, the max pain for me was 382. So the fact that they had such a hard time actually moving the stock down into the close on Wednesday just means that these bulls really want to buy. It really shows us that 380.5 might actually now become support. So we note here that on the 15-minute chart, it was a relentless move higher. And they only slammed it in the last 30 minutes because the printed close at 4 o'clock is what determines whether or not options are in the money or out of the money. So we can note that the bulls were pretty excited all the way up to 386. They walked it all the way back down to burn all of this premium. And same thing on the put side. They burned everything, which means the market makers are fully in control today. So if they were fully in control today, has anything changed in terms of max pain going into Friday? And then also, are there any clues for our monthly chain for July 17th? Here's going to be the one for tomorrow. We're looking at SPY on July 8th for the 16s. And for me, what I'm noticing is that we got 100,000 in volume here at 385 and 100,000 here at 380. I would assume this is going to be a put spread down to 375. So what that means is that they want it down. These guys here want it up. So where would max pain be? Somewhere between 380 and 385, somewhere in this range. And is it any surprise that we're closing out in roughly the midpoint here, 383, 384? So again, 382.5 would be the midpoint, and we're roughly there. What it also tells us is that bulls and bears are also motivated. So when we look up here, they're actually buying 390 calls for when? For Friday. That's in 2 days. These guys seem pretty bullish. This is new for me too. We've not actually seen bullish calls or follow through for quite some time. All right, now we're going to have a look at the monthly chain to see if they're just bullish for this week or if they're bullish beyond, because it's been quite bearish as I've been looking for a while. All right, so now as we have a look here, what do we got? We got some volume here at 380. Again, assuming that it also goes down to 375. And then over here, we got a 385 and 390 call spread being built. So The same numbers are going to be in play for the rest of the week and through to July 15th. With that said, if you've enjoyed the video, I would really appreciate a thumbs up, and leave me a comment if you want to support our channel. If not, there will be a video that queues up here in a moment, which is going to provide you with our deeper thoughts from the weekend in terms of where we thought we would go and how we prepare our strategy for the week ahead. If not, thank you for watching, and I look forward to seeing you tomorrow. Thank you.